Hey everybody, welcome to another Founder Roundtable. I'm Jonathan G. Blanco with TF Labs and Higher Streams. As you all know who are here, we do a weekly conversation where it's just an open talk and we get to learn from each other. I'm really excited to welcome our guest today, who is Kathleen Baxley. I've known her for a couple years now. She is a interim, or not an interim CFO, but a CFO for hire, interim CFO, fractional CFO. Definitely someone that has a lot of great information when it comes to the things that revolve around that, like valuations and revenue models and how are you going to start hiring employees and your employee plan. So with that, I'd like to welcome Kathleen. If you could introduce yourself to everybody, and then we'll get started in the conversation.
Yeah, good morning, everyone. I'm happy to be here. To tell you a little bit about my background, I've been working in financial modeling and business development in a lot of different capacities, both at a startup company that was building its own lines of business, where I did all the modeling for that. I worked at some major investment banks in New York for 15 years. So that was doing the modeling on a very large scale. And I've started a couple companies of my own. And what I have come to realize is that I really love doing the modeling part, and I really don't want to operate a company. So what I do is I work with startups now to provide the financial modeling services, cap tables, any of the sort of quantitative analysis that you would do on the financial side. I also help with how to present that story to investors and, tell it in a compelling way in the language that investors are going to understand. And then kind of the last piece of what I do is I work with the founders to make sure that they understand all of their numbers, why they're important, what they, what's kind of the right benchmarks to be looking for. And when you go into a meeting, here are the things that they're going to ask you, and here's what they're actually really asking, and here's where you want to kind of, how you want to tell your story in that context. So my offer is anybody who wants to talk about their finances, you have questions, whatever, feel free to give me a call anytime. Jonathan has my contact information. And my ask is, if you know anyone that needs a CFO and isn't ready to hire a full-time, give me a shout.
So. Sounds good. I saw a couple people raise their hands there.
Yeah.
So, we've all, most of us here have probably spoken to an investor and they're like, hey, like, well, what do the numbers look like? And, it's a lot of times we might just grab a dart and throw it at the dartboard and think it goes, but there's really, ways to be backing into that, right? Like, hey, well, we're going to have the product built around this time. So then we should see an influx of users there. And then we're bringing on a digital marketing hire, and that digital marketing hire needs to be someone that really understands the funnel. And so we anticipate an uptick in users there. And then, we're bringing on a business development person in month 5. And that business development person is the type of person that will have, contacts with our target user or target customer. And so that's why we'll hear, right? Like, that's why you should have, we're going to have 20,000 customers at the end of year 1, not because we just think that that's what a growth rate is, right? You got to tell the story in each place of like what creates those little upticks. So, go ahead, Kathleen.
I was just going to say, part of what you're doing with the model is you're taking massive uncertainty.
Correct.
And you're funneling it down to, okay, well, what are the things we actually do know? And how do we create a story that follows that? And it's not, here's how big the universe is, and we're going to get that percentage of it. It's, here's how many dollars we're going to spend on marketing in this capacity, and those dollars are going to generate this revenue. And whether it's salespeople, how much is each salesperson going to be able to sell, or if you're doing internet advertising, what kind of response rates you expect from that, those kinds of things. So you're taking all of these unknowns, identifying which are the moving parts, and starting with the first thing that you do, which is, build your product, then go out and look for customers and then get the customers and then serve the customers.
And creating financial models can be kind of frustrating for the perfectionist person, right? Because it's like, hey, how do I get these numbers exact? But
Yeah.
no one's actually expecting you to have your financial model 100% spot on. But the people that are investing your fellow, co-founders or team that you're hiring, they just want to know that you've thought through it enough where it can make sense in a story, right? So I want to start the conversation and get everybody else involved with this. So I guess first and foremost is, has anybody here built out a financial model before? And, how, if you have, what has that experience been like for you? Randy, you want
So
to? Oh, go ahead.
I'll start. Yeah,
Sure, go ahead.
built multiple financial models, and it's it's a process, and it's always a living document, and it keeps changing. So getting it right and having the right strategy is important, and the more financings that you get through, the more complex the financial models are going to get. And agree with what Kathleen was saying there.
Yeah, I'd agree with that. A lot of people say to me, when is it going to be done? And it's never done. You're constantly adapting it to the new information that you're getting as you go along.
Right. It actually should never be done, right? If you're
right.
still building
when you got a business, it's done.
Right. If you're using your financial model, the same one you started with, 6 months later, like that shows that you haven't done any validation or testing or, checking out where things are going. Anybody else want to?
Yeah, how early in the life cycle of a startup do you recommend we start looking into that? Because I think I have a beta launch, for example, planned for end of January. And I don't think I'll have much revenue until maybe Q2. And that will be little. Like, when should I start thinking about this?
I would say, well, a couple answers to that. One is I would start thinking about it as soon as you start to formulate, well, how is the money going to come in? Who are my customers? What am I going to charge them? Where are they going to come from? And starting out with just guesses.
Yeah.
And as you get more information, you can refine that to go forward. And the second thing is that one of the things I frequently run across is people who say, okay, I've got my business. I'm going to go out and look for fundraising. Can we put together a model? And then it's too late. It can take you a year to raise money. It can take, 100 meetings. How long is that going to take? You need to be building your model as early as possible, in my opinion.
Yeah. And I think along with that is it's okay if your financial model shows zero, right? If it shows $0 for month 1 and $0 for month 2 and $0 for month 3, that's okay. Hopefully it starts to get above 0, after a few months. But, but perhaps even though it's at 0, you have a different chart that's showcasing your user acquisition, right? So like, hey, like we have 0 revenue, but our customers are growing by X. And then you start to tell that story. Is like, once we have 1,000 customers, now we can start introducing this product that we charge $5 a month for, and we think we'll convert 10% of those 1,000 people to start. And you just basically start piecing that story together, that someone can start understanding, oh, this is why in month 5, Lisa is saying that she's going to make $500 a month, because at month 5, this inflection point happens.
And it can be a year and a half or 2 years before any dollars come in. So, and that's the importance of doing it monthly, because you're going to have a big trough before you start to see any revenue. And that's what investors expect. So,
Serge, you look like you have something to say.
Yeah, I've built financial model for 2 businesses now, in-depth models. And it does. I mean, it's something you want to do, essentially from day one, because you want to understand your metrics. Because, the revenues are what's driving your business, but also you have expenses as well, which is, who are going to help drive that revenue, or what is going to help drive that revenue? Is it marketing? Is it sales? You know, and so, and you know, yeah, and so the business model never, you know, never ends. You always updating it. I think what's been fascinating for me is once the business gets going, you know, you need to start getting actuals in there, right? Because now you have projections, which you initially do based on guesses, right? Like Kathleen said. But then once you're operating, you know, as in you're paying yourself or your first customer is paying you, then that starts to change. You know, yeah. So then I started wondering, you know, how, I think for me, I'll speak of the challenge, right? Then starting to think about how do you reconcile the actuals versus the projections, right? Because then they all, you know, they all continue to change, and yet you still need to tell, especially when you're raising funding, you need to be able to tell a compelling story to investors based on actuals and also based on projections. And so that becomes a, you know, dichotomy that you have to live between. And so it's always useful to start, you know, that projection or that modeling from day one, so that you could have an understanding as actuals are coming in, right, to have a good idea what's really helping those numbers grow.
Yeah, those actuals are what you use to refine the future. You know,
that's correct. Yeah, yeah. And then your model starts to get fine-tuned based on the actual data that's coming in, right? So whereas you projected that you would get, you know, $20,000 in revenue in Q3 or Q4, you know, based on your actuals, you could say, hey, you know, that may actually end up being 25K, or that may end up being less because, you know, based on this trajectory, it turns out we're getting, you know, 5 customers per week as opposed to my projected 10 per week, right? And then you also have to factor in holidays, right? So for example, a lot of founders, you know, they just think that their growth is going to be this exponential growth, which is beautiful to look at, you know, but the reality is comes Thanksgiving, you know, comes November, people are starting to get ready for Thanksgiving. And so your sales start to, you know, to diminish. So therefore your projections are not accurate, right? And then comes Christmas, you know, sales definitely go down because, I mean, depending on your industry, right? Sales go down because it's the holidays, people aren't thinking about making purchases, right? And then based on your specific industry, you know, that sales cycle may be different, right? It could be that it's, you know, you're projecting that you're going to have this exponential growth during June, but in reality, in your industry, sales are actually a little bit down because perhaps people are, you know, that's when people take vacations, right? Or perhaps that's when industry-wide sales just slow down, right? I think those are all things that you have to consider where you're putting together the business model for your specific industry, so that you're not making projections that are too unrealistic, right? But that can really help drive your business in a realistic manner.
And along with that, Serge, you know, because you're talking about like the holidays and, you know, SaaS is nice, right? SaaS is predictable revenue, you know, and ideally, if you have a SaaS model, your business is consistently going up and up and up because you're just adding new customers. Not every business works like that, right? Some businesses are transactional, but also your SaaS model might be an annual SaaS, right? And so there might be like one, sure, your month goes up, and then you have 1 month where it just goes really high, and then it goes back down because it's annual SaaS. Again, like, you know, that's not bad at all. You just have to tell that story, right? So, hey, like, our numbers catapult and then they skyrocket down again because we have our monthly SaaSes. But, you know, we did this great promotion when we first started, and it was in January of the year, and whatever, right? Whatever that story is just all about telling it.
That's a very important point on SaaS. Is there's a difference between cash flow and earned income. So when you collect the full annual subscription on day 1 of the year, you're getting 12 months of payment. So that's cash coming in the door. But when it comes to your profit and loss statement, you haven't actually earned that income until you deliver each month's subscription. So if you think about it like a magazine, you pay on day one. So that's cash in the door of, call it $12. And then in month one, you serve one issue. So that's $1 that you don't owe anymore. Month two, you serve another issue, so you only owe 10. Next month, you serve another, so you only owe 9. So you have to keep track of the difference between what is cash coming in the door and what is earned income, because that lumpiness that Jonathan talked about is essential to know, because that's how much cash you need. But when you're talking to an investor, that's not how much cash you've earned. You haven't earned it until you deliver the month of service or the magazine or the whatever it is that you're selling each month.
Lots of. I'll add to that. It makes investors definitely love the prospect of you selling yearly subscriptions, because it means the customers are already bought in for the entire year, which is beautiful. Yeah. So what if you assess, I think I would say this is one of the reasons investors love SaaS businesses, because you can pre-sale, a year ahead and have money in the bank, and then. But from your modeling standpoint, you want to make sure that you're accounting for it on a monthly basis, right? Or based on, when you're delivering, because that helps make sure that you're not thinking, oh, we have, we have $1 million in revenue. We should start, hiring all these people. You should account for the fact that, actually you should account for it on a monthly basis to say, hey, that actually means we shouldn't hire this many people. Right, because you want to make sure you can build a business that will be profitable, right, based on your earned revenue rather than your yearly subscription. I mean, I think there's some interesting things that you can do there, which I think Kathleen is much well versed in when you're because you want to consider what GAAP accounting, right, versus all the other accounting terms that are out there, just to make sure that you're running a business that is sound.
Yeah.
One way to, I was just going to say, one quick way to think about that is when you take in the $12 from an accounting standpoint, what you're going to do is you're going to deliver 1 month and you're going to have an obligation for 11 months. Next month, you deliver the second month and you now only have an obligation for 10 months. So it's $12 come in, and then $1 a month gets earned.
Got it. Neeraj, I think it looked like you wanted to say something.
Yeah, real quick. Thank you. I'm in the 20 plus years in the B2B, so very different sort of a model. I actually appreciated the fact, being a product guy, the notion of perfection. As a product person, you actually want perfection. When it comes to business modeling, I guess it's perfect for the moment you are in, and the moment you are done, it's actually imperfect at that point of time. That's a hard, swift mental model to actually think about. I have two questions actually. So when you think about seasonality, and Sarge mentioned about baking into some of these things, how do you all account for businesses which are SaaS? Even in the current model of SaaS, traditionally used to be contracts, but companies sign up for 2 years or 3 years. I'm coming from an HR sort of benefits market example for a moment. And companies sign up for 2-year, 3-year contracts. Attrition or churn is extremely low because you're signing for benefits. You don't go shopping for benefits every year. How do you account for that kind of a modeling that may not start going, Lisa, to your point earlier, first year is basically going to be zero, period. Only no revenue, just going to be a bunch of expenses, because no one's going to say, you can take over running my benefits in the first year without you having proved your mettle. How do you account for those kinds of things? And how do you counter back to the investors from a standpoint of, look, my first 18 months, I'm really not going to bring any money in, but we will get 2 or 3 customers in year 2 post 18 months. And that's when the projection starts to actually start looking a little more positive. from a standpoint of just collection, not saying profitability, but just being revenue coming in.
On that point, I would say if you're a B2B SaaS company and you're talking to the right investors, they already know that there's not going to be any revenue. You're coming to them for money because you know that the expenses are going to be very large before $1 comes in. So that should be something that they're already familiar with. And in fact, they expect. So if you came in with a SaaS company, B2B, and you said, oh, we're going to make all this money in revenue in year 1, they would say, you're crazy, go away. And then on the renewal and the sort of revenue cycle, I focus on when do they pay? Okay, so if they pay once a year, then I would build it out as an annual amount. And then, so January 1, year 1, you get the payment. January 1, the next year, you get the payment, et cetera. And you have a very, very high renewal rate, 99% or, so what that shows is every year you're getting the cash payment. You know that most of these people are going to renew for the first 3 years. And that's really your visible time horizon anyway. So if you assume annual payments, each month you're going to have a certain number of starts and they pay you. And then you have the earning of that income over time. And if you build in high churn, you know that there's going to be, high renewal, there's going to be a very small amount of churn that's going to happen, whether it comes from this account or that account, you don't really know. And churn can be for all kinds of reasons, employee, if it's a benefits thing, they fire a bunch of employees, that could go down, or if they, their client companies go out of business, whatever. So I just say, if they're going to pay me once a year, then I know this is when I'm going to receive payments. I know that there's going to be some small amount of churn. So I'll just build in that every year.
Yeah,
Question on the churn. Would you say the churn would be like 10%, or would you do it something smaller, or what would you suggest for?
It totally depends on the business. So if you are a benefits company and you have 3-year contracts with people, then your churn is going to be pretty close to 0 for the first 3 years. If you are, an app where people are signing up and they're paying you by the month, it could be 40, 50, 60% a year. Sometimes you have an app that somebody might buy because it has immediate utility to them. Maybe there's some change in their life and this thing becomes important and it's a learning tool for them to deal with whatever the situation is. They might be on it for 4 or 5, 6 months and then go off. So it's understanding what are the characteristics of your product and your customers that's going to dictate that. And you
sorry, can I actually interject there, because that leads into a question that I was having. So I actually I think the model is going to switch back to contracts. So I think the SaaS model is going to go away. That's just my opinion, but also
depends on the business.
True. So my business sells, our product is a meta deployer, we have, I guess, now another product that's a deployer, and it deploys a contract. And this contract is a savings bond. And the savings bond has a liquid and illiquid side of the bond. And the liquid part has a fee and fine structure. And so once you purchase this, we have, a variety of triggers, and it's pretty simple, but it's just, a couple smart contracts, or it's just couple smart contracts and contained within a larger contract. And then that pays us a revenue stream back to the deployer. But that deployer is contained within its own entity. And so, I mean, our company owns that entity, but it doesn't necessarily pull a revenue stream from that exactly. How do I, how can I project that out to investors? And how do I really demonstrate, these smart contracts and the fact that the entire model is going to be changing shortly?
I think that's a very specific situation, but what I would do is I would look at just kind of track the dollars, do just like a diagram of this is where the dollars come in and this is where they go.
What if I'm not tracking dollars?
Well, you need to be tracking dollars to talk about revenue, right?
I count my revenue in I account for my revenue in Bitcoin. I actually don't.
So just whatever current
dollars.
Just whatever currency for you, just whatever currency that is, whether it's Bitcoin, Ethereum, Euro, just whatever your currency is.
Okay.
Yeah, I mean, what you need to be able to communicate to investors is here's how much money I need. And so whatever currency they're paying you in, that's the currency that you need to express. So
yeah, Bitcoin is a currency.
Yeah.
I mean, you can't track revenue without
money.
Currency.
It's money, actually. Federal court in Washington, D.C.
Yeah, so currency.
Money. No. Money and currency have a distinct difference. Currency is a debt instrument that's built on top of money.
Sure. Yeah. Okay.
So it's distinct, different, totally different.
Actually, that's a very big misnomer out there as well, that Bitcoin is a currency. And that's fundamentally driving some of the other aspects. Sorry, I come from a fintech background, so very close to it, but I agree with Jonathan. There is a huge difference, and the lack of understanding of that difference is driving a lot of people to kind of be scared about this thing instead of saying, this is the future.
In my opinion, this is the future. And in my opinion, the architecture is going to change. And the architecture in any asset management structure starts with trust companies. And if you don't understand that, then you don't actually understand the financial architecture that we exist in. And that's just a really pointed position, but I've been studying this for a while. So
and to be
but if you need cash today,
right. Yeah.
Cash is the currency they use.
Yeah. To add on to
I can wait it out.
Point.
So
yeah, but most companies can't.
Yeah. So to add on to Kathleen's point, so many companies, you either, as you do in your financials, right, you can actually pick whether you want to account for revenue on a monthly basis or a yearly basis when creating your model, right? Which means that, you should have a model that sort of takes this revenue, the frequency of revenue into account, right? And oftentimes, basically what that means is, whether you input your frequency to be annually or monthly, it's able to allocate those funds accordingly, right, in your projections, so that when you're looking at your charts, right, if you create charts or anything of that nature, it will account for that revenue for you automatically, right? And so you're not having to look at a chart where you have this lump sum, right? But it would actually distribute it for you based on whether or not you pick that the revenue is monthly or yearly. So just want to throw that out there as you do in financials.
What I would add to that is that there is obviously nuance to Bitcoin that is specific to companies that are operating in that sphere. Most of the time, it's companies who are starting operations today and they need to pay their bills in the currency that's in front of them. And when you're talking to investors, the currency that they have is dollars. So that's the language that is, pretty almost exclusively, in my experience, talked about.
When do you think that exclusivity is going to change? I see a flippening happening when it comes to that.
Years and years.
Yeah, it's going to be a long time.
Yeah,
you got to remember. So I mean, because we can go. Let's kind of pause that part of the conversation because we're going to go rabbit hole. But you also got to remember that people do what's comfortable to them, period, right? We all do what's comfortable to us, right? Like I get up in the morning and I make some coffee because that's comfortable to me, right? And so you use the currencies that are comfortable. So you have an existing financial establishment that lends dollars and they get LP money in dollars. So like there just has to be like a major shift. It doesn't mean it won't happen. It's just that we're a ways away. So I want to pause that side of the conversation because we
so
should
just real quick, Jonathan,
we should do a whole nother conversation around
go ahead.
Bitcoin and crypto, because that's what we do a lot in TF. So for those that don't know, TF Labs puts on conferences and events as well. And we do a lot of things with Bitcoin and cryptocurrency. So like today at 5 o'clock, we'll have a conversation around the Stable Act. It's going to be, which is a bill that's getting proposed for regulation in cryptocurrency. So that'll be today.
My product is for that.
Join us. And then next Wednesday, we're going to be doing a Bitcoin roundtable as well. So join us that. But I'll do a Bitcoin talk for the founder roundtable as well, because I think that would be really fun. Serge, you wanted to say something, but then I want to move away.
Just super quick. I don't know if this is a direct strategy for me, but my only investment is in Bitcoin. So
yeah.
Good man. Hey, NFT derivatives are something that's coming up. Governance tokens and NFT derivatives. Governance tokens are technically derivative tokens. So if you want to capture both sides of money and ownership, then you look for derivative assets and money assets. So
all right, cool. I think we should pause this combo.
Later time.
I have a dollar related question.
Yes.
So
back to dollars.
Yeah, back to dollars. So for me, revenue is a bit more, familiar because I come from a sales background in recruiting. But I'm a little bit scared as a first-time founder of the operating cost. And I'm not quite sure yet how to calculate, my monthly expenses, specifically when it comes to, AWS and other technology providers. And so I'm currently actually looking for someone who can guide me around these topics so that I can budget. And I was wondering if that is something that you typically do for startups.
Yeah, there are rules of thumb that kind of depend on the volume that you're anticipating, what kind of scale you're operating at. So that's something that's, that we work with, but it's not like here's a number that you can have, but it's usually based on storage capacity and those sorts of things, and looking at comparable companies. But there's two pieces to your expenses. One is the cost of building the product, and you're going to incur those costs before you have $1. And then there's the cost of running the operation. And for companies like yours, the operating costs are very low. That's part of the appeal of the model. Is once you build the base, you can overlay as many customers as you want.
Yeah, your biggest costs are usually humans, right? And then like the actual building costs.
And the marketing costs.
And market. Oh yes, of course.
To bring in that's huge.
Yeah.
So the only thing I would add to that, if I may, is because you mentioned AWS and stuff, you have to be very careful of having people on board who understand when to not to leave machines running, especially if they're spawning new machines, because you could budget as much as you want, but one simple mistake on somebody's part, not a mistake, it's more like didn't think of it, could really run out your entire startup budget for that month into just because that machine's running, you're paying, and there's just several $1,000s could be. If you are interested, we've just done this. It requires, Kathleen's absolutely right, the rule of thumb things into it, but it also requires somebody who's aware of what they're doing. I'm happy to talk to you offline and help you set something up if you need be. Yep.
That's where staffing and expertise and having actually done this before comes in.
And Kathleen. Yeah, Kathleen, I think I would love to chat with you offline because it sounds like, my new software could be a great arsenal for you as you work with a lot of founders and startups, like the question Lisa asked, such as, how do I factor in AWS costs and things like that? I'm actually standardizing that in a software where, essentially it guides the user, right? So it's a self-guide and including those expenses. So yeah, I'd love to
Yeah, let's connect.
Let's chat offline. Yeah.
Perfect.
Cool.
Hey,
So real
Kathleen,
quick, because people
yeah.
start to drop off here, let's take a quick little group photo. I'm gonna do a screenshot. So
Well, while we're doing that, can I ask Kathleen a quick question?
we'll just smile real quick and then ask the question. Okay. 1, 2, 3, smile. All right, go ahead, Randy.
Hey, Kathleen, just on the schedule or the projection, typically, is it more standard to go 5-year or 3-year in your projection? Because I get a little pushback from other people talking about that. I like 5-year, but some people come in saying 3-year.
The beauty of doing 5 years is that you can only show 3 years if somebody wants it. You know,
Okay.
to me, I think it's just as easy to do 5 as to do 3, because all you're doing in years 4 and 5 is projecting out some growth rate on the things that are already existing, and you have the formulas to interact with all the costs and so forth. I usually do 60 months across, and then I have a summary quarterly and a summary annual, and then show people whichever piece of that they want.
And for your operating expenses, how detailed do you typically do that for a schedule that you're going in front of investors? Do you go as far as showing, you know, the amortization of equipment, hosting charges, advertising, all that in your detail?
Yep.
And with that, with some of that, do you use some of the, what are some of the common factors, I guess, for calculating like payroll, employee, and G&A? I mean, we've got information like for G&A expense, we just do 0.14 of the revenue coming in, and I think 0.32 employee benefits. What are there different standards?
Well,
things?
Yeah, there are some different standards, but what I would say is you want to look at each line item on its own and say, you know, okay, well, rent is going to be a factor of how many employees you have. So how many, you know, whatever square feet per employee, cost per square foot, or, you know, you could use just like $100 an employee or something like that. And then I always build in at least a 5% annual inflation. So whatever the thing is that drives the expense, that should be detailed out, and the cost should function on that. I use 20% for benefits. What else were you asking about? You know,
one question that came, it was a table topic, and I don't know how valid this is, but we were talking about discounting the money coming in, or discounting the value after 4 years, 5 years. Do you do anything like that, or is that, maybe I'm saying it incorrectly? But,
well, I think you're talking about discounted cash flow or some kind of valuation. Yeah, absolutely. Right. And the discount rate is very high because if you think about what the discount rate is, it's a reflection of the probability of something occurring. And so what you're doing is just saying, I think I can make this much money. Yeah, but, you know, 90 out of 100% of the companies that do what you do fail. So you have to take that into consideration and say that it, you know, so yes, you discount. But what I would also say is that discounted cash flow for a startup company is, you know, it's premature because you don't have cash flow. So how do you discount it?
Right.
Yeah.
Right.
So real quick, because we're about to wrap up and we haven't touched this subject yet, so I'd like to just hit it, is valuations. So what are some ways that some of you have gone about, you know, thinking about what your valuation is, or, you know, if you're pre-seed, you know, you have to, you set up a cap. I'd love for people to kind of think or share what they've done and how they've come about that.
I just say 10 million with confidence.
Yeah, I think that's great. Well, yeah, I think, yeah, it's interesting. I think in the past, what's been useful is you want to set a valuation. Your valuation determines how much equity the investor owns in the company, right? And the amount of capital you're raising. So if you're raising, you know, $2 million on a $10 million valuation, you know, what does that get? Like 20%? You know, that means your investor, post money, right? Yeah, post money. That means your investor will get 20% of the company, if I'm doing that math right. And so, you know, and so depending on how much you want to give away in equity, right, you can set, well, usually investors set the valuation most of the time. So, you know, I think most investors are savvy enough to offer valuation that oftentimes as a founder, you know, you could counter for sure. But I think in this day and age, most investors know, you know, how valuations work. And so you just kind of have to, you know, play with whether or not you agree with them owning this percentage or not, right? And if not, then you could negotiate further and say, hey, look, instead of you owning, you know, 30% of my, you know, seed and at my seed round, I'd rather do something where it's 20%, right? Because we all know, you know, the more equity you keep, right, early on, the better. But yeah, I think specifically what I've done in the past was just kind of tell the investors, well, the investors have offered, made offers, and you kind of negotiate if it's not exactly what you want. But oftentimes I found that it's, you know, it turns out just fine. But also, I've also done one where I pick the valuation and I say, you know, this is the valuation because this is how much I wanted to give away, you know, in the company, and that also worked out well. But a caveat to this is, I think it always depends on the investor. And another investor may come in and they would say, you know, that valuation is too high, or you give away too much of the company.
Well, I think along with that real quick is you also have to make sure, and you're probably alluding to this as well, is that if you're having a VC conversation versus an angel conversation, like they're naturally at a disposition on what the preferred, you know, value could be there too, right? And then also if you're raising from someone in, you know, in the Valley compared to someone in, you know, a smaller market, right? Is like now, like that's also going to show that differentiation and value.
What I would add to that is you're not in the driver's seat when it comes to valuation. The investor is going to tell you what they're willing to pay. And what you have to balance is, you know, there's a certain size check that certain investors write, like an angel investor. You should know going into the meeting, what size check do they write? And how much you're looking for, and you're fitting into a system that already exists. They're not going to adapt the system for you. Yeah. So knowing kind of how much gets raised and around at what stage, and keeping in mind that with each valuation comes expectations. So it's not just, I need this money, it's I need this money, and with this money, I am going to deliver these milestones. So, you know, that's why you want to measure, when do you need the cash? Where will you be when you need that cash? And kind of what has been happening in the marketplace for companies at your stage in your area. You know, yeah, and how much equity are you going to give away for that? Like, basically, you could say, I need, you know, $250,000. I need $500,000, and they're going to say, okay, well, for that we want this much equity, and you're going to look at that and kind of weigh your options. And this is what we expect.
Yeah, I think oftentimes too, you can only set the valuation if it's with angels who aren't always investing in startups. So you're actually helping them. And it, you know, doesn't mean it's necessarily smart money, but you're putting some numbers up so that, you know, you can get a round done. But you want to make sure in that case, since they're not, you know, savvy investors, that you don't shoot for too much of a valuation to hurt your next chances, right? So if it comes down to you setting the valuation, make sure that you do your research and that you're decent. Decent is, you know, relative word, but you're decent with the valuation with an investor who may not be savvy at it, because whatever number you choose will hurt or help you in the future.
Yeah, definitely. Awesome. Well, Kathleen, what are some good ways that people can get in touch with you? I can, of course, pass your information along to everybody, but do you want to share perhaps your email?
Yeah, I'm at Kathleen, Kathleen, at startupvaluationresources.com.
Perfect.
And yeah, and I'd love to chat with anybody that's got questions or whatever.
Excellent. Awesome. Well, everybody, thanks for joining another Founder Roundtable. Our next week, we're going to be talking about B2B sales. So definitely recommend joining that one as well. And then the week after that is Christmas Eve. So for those that want to join, we're going to be talking about just managing the holidays as a founder. And the 31st will be Christmas, or not Christmas, 31st will be founder New Year's resolution.